Explain how this would work, Senator.
Yeah, so the basic idea is that if you think about the FDIC taking a bank into receivership is effectively, implicitly putting taxpayers on the hook. It allows the FDIC to go and claw back compensation that executives paid themselves as they were running their banks into the ground. This is specifically motivated, Neil, by the SVB situation where you had a bank that really was terribly mismanaged, a CEO paying himself millions of dollars in bonuses in the weeks and years running up to that collapse. And yet when the taxpayers got put on the hook, they had no recourse. And what I'm really worried about here, Neil, is not revenge. I could care less about the SVB CEO at the end of the day. What I do care about is whether we have a banking system where the small banks are playing by a different set of rules than the big banks. Everybody knows a community bank in the state of Ohio, they're going to suffer the consequences if they get put into receivership. But if you can pay yourself fat bonuses by running your bank into the ground at a big bank, that's a problem, and that's a problem we got to fix.
So, Senator, what happens though if it starts a selling contagion among bank stocks, which we've seen sporadically over the last few months? Would you be just as tough on management of those banks that were sort of caught up in the whirlwind?
Well, I think we need to be tough on the banks, Neil, because it makes these financial institutions ultimately more cautious. The big problem in the American financial system is that we have socialized risk and socialized downside, but we have privatized reward. So if these CEOs know that they're going to benefit from what is effectively a bailout, whether it's the uninsured depositors or even the shareholders and executives of the banks, they're going to take more risk and they're going to expose our financial system to more danger in the process. That is a bigger problem than just this piece of legislation, but this legislation does fix one tiny part of that issue.
You know, whatever happens to these small, medium-sized banks, and I get where you're coming from and where Elizabeth Warren is coming from, sir, but I do wonder about banking itself, and that after the meltdown, we were told that, you know, no bank could be too big to fail. Now, of course, they're getting bigger, those banks, and it's possible that they'll get bigger still at the expense of smaller, medium-sized banks. What do you think of that?
Well, it's a huge problem, Neil. We really can't overstate this enough, that one of the things that makes our country special, unique among the advanced economies, is that we have this really robust small and medium-sized banking ecosystem. The problem is, because of that implied bailout, because the big banks know they're going to get bailed out by the taxpayers, but these smaller and regional banks don't have the same promise, it makes it harder for those guys to do business. It increases their overall cost of capital. It sometimes even means they're sharing more of the regulatory burden, even though they're not the ones who are going to ultimately benefit from that bailout. So we have to do that. We have to protect that system. It's, you know, look, some of these small banks are making loans to customers and to small businesses that big banks would never touch. It's a core part of American entrepreneurship to preserve our banking ecosystem. And I think this is one legislation that solves that problem, or at least makes the problem a little bit better. One of the things we're going to have to tackle, though, Neil, long term, is this implicit promise of bailout and the fact that it's there for the big guys, but it's not there for the little guys.
Yeah, and if you know that, so your backstop, you'll go ahead and do a lot of things because you know that support's there. Senator Vance, very good to see you.